Oh, thanks for asking that question. What are the terms of investment, including the potential risks and rewards? Let me kind of put my mind together. Well, see, the thing is, in commercial real estate, where I am most of the time, and along with startups and all, and NFTs and all, and AI, all these things, I'm very excited what's happening in my life. The key thing is in real estate syndications, typical investments where multiple investors pool their money legally together to purchase and manage a commercial property. That's syndication, which I have been involved in for 15, 16 years. We've been in real estate over 40 years, but the terms of these investments can vary widely. But here are some of the potential, I would say, terms and risks and rewards. The terms are capital recontribution. This is the amount of the money you invest in the syndication, number one. Preferred returns. So preferred returns are, this is the amount of the return that investors receive before the sponsor or the general partner takes a share of the profits. That's why it's called preferred return. So 6%, 7%, 8% cash flow if the property is making, profit, whatever asset class it is, then that's pref return. And then in our case, if we miss the quarter, we catch up the next quarter and all. That's pref return. The equity split is the percentage of the splits that the investors or the general partners receive. So in other words, in the early part of the syndication, maybe 80% of the cash flow is going to the investors, or 90% even, and 10% to the general partners. So the investors get paid first. I like those, and that's what I've been preaching and talking and teaching. The other part is there is IRR, internal rate of return. So when we exit, we want to make sure that our investors are paid the equity gains first to 15, 16, 17, 18, 20 IRR, and then whatever is left behind is given to the general partners. So that's the equity split, we call it. Hold period is a big one. Hold period is the amount of the time that the syndication plans to hold the property before selling it. That's the hold period. Usually 3 to 5 to 7 years, is the one. Promote, that's another word. This is a bonus, to the sponsor or a general partner if the investment achieves certain performance metrics, we call it. So what are they? They are like, for example, IRR of reaching 17, 18, 20%, the splits could go from 80% to 50-50. Or like in developments, I've seen where they could be 70-30, but then after we reach that 70-30 IRR of whatever 19 or 20, it flips to 30-70. I've seen some deals come on my desk like that. So those are the promotes, we call it, or equity shares. What are the risks, you may ask me? Market risk. Big one is market risk. Changes in the market, market could really affect the value of the property and the potential to returns to the investment. So that's the other one. Property risk is there too. How old is the property? Unexpected maintenance. CapEx, we call it in our field. Tenant vacancies, resident, we call it, and other issues that can affect to the income generated by the property, which is potential returns can be slowed down. So property risks are there, liquidity risks are there always, because once you invest, these investments are typically illiquid. Until you sell or do a refinance, we call it waterfall in our language. So, meaning that it can be difficult to really liquidate or sell your assets before the whole period that the sponsoring group is telling you. And then sponsor risk is there. The success of the investment depends on, in the skills and experience of the sponsor, the management company, and everybody, general partner who is really researching and track record. You need to look into all that. The other risks could be cash flow. Investors are in commercial real estate may receive regular cash flow distributions from the property income. That's a good point. Appreciation is a great point when the property value goes up. Tax benefits are great things, for tax benefits in doing cost segregation and all, having negative passive losses, all that. But please do involve your CPA or attorney and financial planner when you decide to invest into any of these kind of things.